What's going on, everybody? It's Agwu and welcome back to the channel. Today, we're diving deep into the world of Forex trading with a focus on technical analysis, one of the most important skills you can have as a trader. Now, I know what you might be thinking. Forex? Isn't that risky? And while there's inherent risk in any market, remember, knowledge is power. By understanding the tools and techniques used in technical analysis, you're not just gambling, you're making informed decisions based on data and trends. So if you're ready to level up your trading game and potentially achieve financial freedom in the process, buckle up because we're about to break down everything you need to know to get started. Before we even think about placing a trade, we need to understand the language of the market, and that's where charts come in. They're like roadmaps, showing us the price history of a currency pair and giving us clues about where it might be headed. Now, there are a few different types of charts you'll come across. First up, we've got line charts, the simplest form, showing you the closing prices over a period of time. Then there are bar charts, which give you a bit more information, showing the open, high, low, and close for each period. But the real MVPs, the ones I personally use the most, are candlestick charts. These bad boys not only show you the open, high, low, and close, but they also use different colors to indicate whether the price went up or down during that period. Trust me, once you get used to reading candlestick charts, you'll never go back. Alright, so now that we can read a chart, let's talk about trends. Think of trends like waves in the ocean. An uptrend is like riding a wave to the shore, higher highs and higher lows. A downtrend, on the other hand, is like being pulled out to sea, lower highs and lower lows. And then there's the dreaded sideways trend, also known as consolidation, where the price is just bouncing around in a range. Identifying the trend is crucial because it tells you the overall direction the market is moving in. Are you going with the flow, or are you trying to fight against the tide? Remember, even the best surfers know when to paddle back out and wait for the next big wave. Now, you've probably heard the saying, what goes up must come down. Well, in Forex, it's more like, what goes up will probably come down, eventually. That's where support and resistance come in. Support is like a floor, a price level where buying pressure has historically been strong enough to stop the price from falling further. Resistance is the ceiling, a price level where selling pressure has been strong enough to prevent the price from going higher. Think of it like a tennis match. The price is the ball, and support and resistance are the lines on the court. Breakouts happen when the price breaks through these levels, signaling a potential shift in momentum, and that's where the real excitement and profits can happen. Let's be real, trading can be a lonely game. You're staring at charts all day, trying to make sense of the chaos. But hey, who says you have to do it alone? That's where indicators come in. They're like your trusty sidekicks, providing you with valuable insights and helping you make more informed trading decisions. One of my favorites is the moving average, which smooths out price data to give you a clearer picture of the trend. Then there's the RSI, which tells you if a currency pair is overbought or oversold, kind of like a mood ring for the market. And let's not forget about the MACD and Bollinger Bands, which can help you identify potential buy and sell signals. Remember, indicators are tools, not crystal balls. Use them wisely, and they can be your secret weapon in the Forex market. Have you ever noticed how history tends to repeat itself? Well, the same goes for the Forex market. Chart patterns are like footprints in the sand, showing us where the price has been and, more importantly, hinting at where it might be going. One classic pattern is the head and shoulders, which, as its name suggests, looks like, well, a head and shoulders. It usually signals a reversal of the current trend. Then there are double tops and double bottoms, which look like the letter M or W and can indicate potential trend reversals as well. And let's not forget about triangles, which can either be continuation patterns or breakout patterns. The key is to learn how to identify these patterns and understand what they typically mean for the future direction of the price. Now let's talk about everyone's favorite mathematical sequence, the Fibonacci sequence. No, I'm not going to make you do math, but understanding how this sequence applies to Forex trading can give you a serious edge. Fibonacci retracement is a tool that uses horizontal lines to identify potential support and resistance levels based on key Fibonacci ratios like 23.6%, 38.2%, 50%, 61.8%, and 100%. These levels can act like magnets for the price, and traders often use them to enter or exit trades. Now I know it might sound complicated, but trust me, once you start using Fibonacci retracement, you'll be amazed at how often the price respects these levels. Now we've talked a lot about price action, but there's another crucial element to consider: volume. Volume refers to the number of contracts or lots traded during a specific period, and it's like the fuel that drives the market. Think of it this way: if the price is moving higher on low volume, it's like a car trying to accelerate with a sputtering engine. It might not go very far. But if the price is moving higher on high volume, it's like a car with a turbocharged engine. It's got real power behind it. Always pay attention to volume because it can confirm or contradict price movements and give you valuable insights into the strength of a trend. Have you ever noticed how your perspective changes depending on how far away you are from something? Well, the same goes for Forex trading. Using multiple time frames from minutes to months can give you a much clearer picture of the market. For example, you might look at the daily chart to identify the overall trend, then zoom into the hourly chart to find specific entry and exit points for your trades. It's like using Google Maps. You can zoom out to see the big picture, then zoom in to get a closer look at your route. Remember, the time frame you choose will depend on your trading style and risk tolerance. Wouldn't it be great if we could read the minds of other traders and know what they're thinking? Well, while we can't do that exactly, sentiment indicators can give us some clues. These indicators measure the overall mood or sentiment of the market, telling us whether traders are bullish, optimistic, or bearish, pessimistic. One popular sentiment indicator is the Commitment of Traders (COT) report, which shows the positions of large traders like hedge funds and institutions. By understanding market sentiment, you can get a better feel for the balance of power between buyers and sellers and make more informed trading decisions. Now let's talk about the most important aspect of Forex trading: risk management. Because let's face it, even the best traders in the world don't win every single trade. The key is to protect your capital so that you can live to trade another day. One essential tool for risk management is the stop-loss order, which automatically closes your trade if the price moves against you by a certain amount. It's like an insurance policy for your trades. You should also determine your risk-reward ratio for each trade, which compares the potential profit to the potential loss. Remember, it's not about being right or wrong, it's about managing your risk so that you can stay in the game for the long haul. So there you have it, a crash course in technical analysis for Forex trading. Remember, this is just the beginning of your journey. The Forex market is constantly evolving, so it's essential to keep learning, practicing, and refining your skills. If you found this video helpful, don't forget to give it a thumbs up and subscribe to the channel for more insightful content like this. And as always, if you have any questions or want to share your thoughts, drop a comment down below.